Our house view at GFMS is that the macroeconomic news flow that we've seen over the last 3 months, which has been broadly favourable, at least the green shoots of recovery that some people have been talking about, we don't buy that view. We think there's going to be a slowdown as we move into the second, third, and certainly towards the fourth quarter of this year and into next year. There's going to be a requirement for the central banks to intervene again. QE3 will be back on the agenda, the kind of balance sheet expansions, all the things that have played into gold's hands over the last 3 or 4 years, we believe will probably come back onto the radar screen. Some of the other producers around the world have been positively minting money on the back of this bull rally, and if gold goes to 2,000, they will continue to deliver great margins, pay dividends to their shareholders, do share buybacks. So it's a pretty good environment for a lot of producers. But there is always this lurking uncertainty of two things. What's going to happen to costs going forward? And the South African story has been very much one about costs. And the other one in the backdrop is gold sustainable at these levels? What does happen if we go into that scenario where gold prices move lower? They can do something about their revenue streams, they can hedge. But producers have shown themselves unwilling to hedge. I would have argued that at $2,000 there were some very interesting opportunistic positions, but the data suggests that the bigger producers weren't taking advantage of that. So there are some options on the table, they're limited, and if gold doesn't go higher, those options are going to be even more limited.